Hello viewers, welcome to my channel. I'm Hasham. So now I'm continuing the problems on ratio analysis. Now in this video, I'm starting from 6th problem. Already 5 main problems and 16 short problems I've completed in the last videos. So if you are continuously watching the previous videos, definitely you will get a lot of command, lot of confidence on this topic of ratio analysis. I told you in the previous videos, this chapter is very important for graduation, post-graduation and professional levels. This financial statement analysis technique, ratio analysis, is widely used to get the information, to extract the information from the financial statements. And the information provided by this ratio analysis will be very much helpful to different parties for taking the decisions. So ratios are widely used technique of financial statement analysis. So what is ratio analysis? What are the advantages, limitations, classification? All these things I've explained in the last video. So before starting these main problems, a student must perfect regarding the meaning, the advantages, limitations and the classification, formulas, everything. Directly if you join now, you may not be able to understand. So I suggest you to go to the playlist of my channel, select the subject financial statement analysis, select the topic ratio analysis, watch the first 3-4 videos. Definitely you will get the concept. So without remembering the formulas, you cannot understand this video. So I suggest you to watch the initial videos not once, twice, thrice. Get a full command on the formula. Then you come to the problem. Now I'm going to start the next problem, problem number 6. So before starting the problem, I expect my viewers to have a printout of the problems, which I have given in the link under my description. So take out the problems, watch the printout. See the printout. Now, 6th problem I'm reading out. From the following details pertaining to J Limited, calculate A, B, C, D, E, F, G, H. All the ratios are given. Gross profit ratio, net profit ratio, operating ratio, current ratio, acid test ratio, stock turnover ratio, receivables turnover ratio and return on investment. These are the ratios we are required to calculate in this problem. So what information is given? Statement of profit and loss of J Limited for the year ended. Revenue from operations. I told you revenue from operation means sales. So revenue from operation 1,80,000, other income 5,000. Total income 1,85,000. Now expenses are purchase of stock in trade 1,05,000 and change in inventories are 10,000 positive. Last 2 problems we have seen change in inventories negative value, but here positive. So what is the difference between this? If the closing stock is more, the difference between opening stock and closing stock is called change in inventory. The difference between opening stock and closing stock is called change in inventory. Now change in inventory may be positive or negative. When it will be negative? If the closing stock is more. If the closing stock is more, then change in inventory will be negative. If the closing stock is less, then the change in inventory will be positive. So here in our problem, change in inventory is given positive 10,000. That means what? The closing stock is 10,000 rupees less than opening stock. The closing inventory is 10,000 rupees less than the opening stock. Opening stock was more. So how much is the closing inventory? See the balance sheet. In the balance sheet, last item you can see inventory. Last current assets, inventories are 15,000. That means closing stock is 15,000, which is 10,000 rupees less than opening stock. This 15,000 rupees is 10,000 rupees less than opening stock. Then what would be the opening stock? 15,000 plus 10,000, 25,000. Opening stock was 25,000. Closing stock was 15,000. 10,000 rupees decreased. Closing stock is decreased by 10,000. That's why here changes in inventory positive 10,000. Next, employee benefit expenses, finance cost, other expense, total expenses, profit is given 35,000. This is the profit and loss statement. Now balance sheet. Equity and liabilities, shareholders fund, share capital 50,000, reserves and surplus 55,000, no non-current liabilities, no debentures, no secured loan. Then current liabilities are 20,000. Non-current assets, fixed assets are given, tangible assets are 70,000, intangible assets are not there. Current assets, inventories, trade receivable, cash and cash equivalent. The balance sheet is tallied 1,25,000. Now complete information is given regarding statement of profit and loss and balance sheet. From this we have to calculate so many ratios. Now first of all, one by one ratio we calculate. The only thing you have to remember the formula. Now first one, very easy, gross profit ratio. Easy formula. Gross profit by revenue from operation into 100. Gross profit divided by revenue from operation. You can call it as revenue from operation or you can call it as sales. Why we are calling it revenue from operations? Because the new Companies Act, the Companies Act has specified the format of financial statement of companies. In that format, it is using revenue from operations. It is not using sales. That's why we will use revenue from operation into 100. The gross profit. The gross profit is sales minus cost of goods sold. Previous problem we have discussed. Gross profit is equal to sales minus cost of goods sold. Now we change the terms. Instead of sales, we call it as the revenue from operations. Instead of calling cost of goods sold, we call it as cost of revenue from operations. Cost of revenue from operations. The revenue from operations given in the problem, but cost of revenue from operation not given. We have to find out. So how to find out cost of revenue from operations? Purchases given in the problem 1,05,000 and change in inventories. We are having positive change in inventories. That's why I am writing positive 10,000. Remember, previous two problems we have taken minus because negative was change in inventories. When change in inventories is negative, we take purchases minus change in inventory. If change in inventory is positive, we take purchases plus change in inventory. That is the difference. Very important to be noted. So here in this current problem, the change in inventories is positive. That's why I am adding purchases plus change in inventories. 1,05,000 plus 10,000, 1,15,000. What is this 1,15,000? Cost of revenue from operations. Cost of revenue from operations. Now you can find out gross profit. Gross profit is equal to revenue from operation given in the problem 1,80,000. Revenue from operation is given in the problem 1,80,000. And cost of revenue from operation just now we have calculated 1,15,000. So 1,80,000 minus 1,15,000, 65,000 rupees is the gross profit. GP. Now we can easily calculate GP ratio. Gross profit ratio is equal to gross profit divided by revenue from operation into 100. Gross profit 65,000. Revenue from operation given in the problem 1,80,000 into 100. You get 36.11%. This is the gross profit ratio. That's it. Second, net profit ratio. The formula for net profit ratio, net profit divided by revenue from operation into 100. Both are directly given in the problem. Net profit is given 35,000 and revenue from operation is given 1,80,000. 35,000 by 1,80,000 into 119.44% over. Net profit ratio. Two ratios we have calculated. Third ratio, it is asking you operating ratio. The formula for operating ratio, cost of goods sold plus operating expense divided by sales according to old version. Now terms will be changed. Instead of cost of goods sold, we use cost of revenue from operations. Cost of revenue from operation plus operating expenses divided by revenue from operation into 100. So here cost of revenue from operation already we have calculated. Cost of revenue from operation 1,15,000 and operating expenses. Operating expenses means all expenses except finance cost. Finance cost is a non-operating expenses. Finance cost is a non-operating expenses. So leaving that finance cost, what are the other costs? Employee benefit expenses and other expenses. Only two expenses are given. You can see the profit and loss statement. employee benefit expenses and other expenses. Finance cost should not be taken. So 33,000 is the operating expenses. Now you substitute in the formula. Cost of revenue from operation 1,15,000 and operating expenses 33,000 divided by revenue from operation 1,80,000 into 100. 82.22% is the operating ratio. Next one, current ratio. Very easy. Current assets by current liabilities. The current assets are given in the problem. Inventories, receivables and cash equivalent. These three are the current assets given in the balance sheet. Inventories, receivables and cash equivalent. 15,000, 25,000, 15,000. 55,000 is the current assets. And current liability directly given in the problem. No calculation, nothing. How much is the current liability? 20,000. Current liability is given in the problem 20,000. So 55,000 by 20,000, 2.75. So 2.75:1. This is the current ratio. Remember, when we calculate profitability ratio, we should multiply by 100%. Whereas in case of current ratio, that means this current ratio, we calculate is to 1. We write down is to 1. 2.75:1. Liquidity ratio. In liquidity ratio, we'll write down 2:1. Now, acid test ratio. It is also called quick ratio. Quick ratio, acid test ratio or liquid ratio means same. So here quick ratio is equal to quick assets by current liability. Now quick asset is equal to current assets minus inventories. From the current asset, exclude the inventories and exclude prepaid expenses. We don't have any prepaid expenses. So current assets are 55,000. In this 55,000, how much is the inventory? 15,000. So 55 minus 15, 40,000 rupees are the quick assets. 40,000 are the quick assets. And current liability is given in the problem 20,000. So 40,000 by 20,000, 2:1. Finished. 2:1 is the quick ratio, acid test ratio. Next one is stock turnover ratio. Inventory turnover ratio, stock turnover ratio means same. The formula is cost of revenue from operations divided by average stock. So cost of revenue from operations, already we have calculated 1,15,000. Average stock. Average stock is equal to opening stock plus closing stock divided by 2. Now, what is the opening stock? See here, carefully you concentrate. Change in inventory is given positive 10,000. Positive 10,000 means the closing stock is 10,000 rupees less. The closing stock is 10,000 rupees less than the opening stock. Then only the difference will be positive. So how much is the closing stock? Inventory. See the balance sheet. In the balance sheet, inventories are given 15,000. Inventories are 15,000. This is the closing stock. Now this closing stock is 10,000 rupees less than the opening stock. Then how much would be the opening stock? 15,000 plus 10,000, 25,000. Opening stock 25,000, closing stock 15,000. 10,000 rupees less in closing stock. How we can know that 10,000 rupees is less? Because change in inventory is given positive 10,000. Change in inventory is given positive 10,000. So 15,000 plus 10,000, 25,000 is the opening stock. So average. Closing inventory is 15,000. Add change in inventory 10,000. So opening stock is 25,000. Average stock, opening stock plus closing stock by 2. 25,000 opening stock, 15,000 closing stock divided by 2. 40,000 divided by 2, 20,000. So average stock is 20,000. Now easily we can find out stock turnover ratio. Cost of revenue from operation divided by average stock. Cost of revenue from operation is 1,15,000. So 1,15,000 by 20,000, 5.75 times. When you calculate turnover ratio, you should write on times. That's all. Next, G. Next point is G. Receivables turnover ratio. The formula is net credit sales divided by average receivables. Now, due to lack of information, we can apply the substitute formula, alternative formula. What is that alternative formula? Instead of net credit sales, we simply take revenue from operations, sales. Revenue from operation means sales. We assume whatever sales are there, the whole sales are credit sales only, no cash sale. That is our assumption if information is not given in the problem. So instead of net credit sales, I am taking revenue from operation. Denominator average receivable. Average receivable we can calculate only when opening receivables are given. In our problem, opening receivables are not given. So we take closing receivables. We'll take closing receivables. The balance sheet. In the balance sheet, last current assets item, you can find receivables. Receivables are 25,000. These are the closing receivables. So revenue from operation 1,80,000 and closing receivables are 25,000. 7.2 times. This is the receivables ratio. Next one, return on investment, last ratio. Last ratio is return on investment, ROI. This is a profitability ratio. The formula for return on investment is PBIT divided by capital employed. PBIT, profit before interest and tax. So what is the formula for PBIT? PBIT is equal to PAT plus interest plus tax. In the previous problems also we have applied this formula. You have to remember. PBIT is equal to PAT plus interest plus tax. PAT is given in the problem. Profit after tax, net profit 35,000. In the profit and loss statement, last item profit is 35,000. That is PAT. Plus tax. But tax is not at all given in the problem. No mention is there regarding tax. So we'll take tax is equal to 0. Interest. Interest is there. Finance cost is the interest. Instead of telling interest, it is using the word finance cost. Finance cost and interest means one and the same. So 2,000. So total 37,000 is the PBIT. Now capital employed. Capital employed means equity share capital plus preference share capital plus reserves and surplus plus long-term debts minus fictitious plus reserves and surplus plus long-term debt minus fictitious asset. We don't have any fictitious asset. We don't have any long-term debt. Debentures or bank loan, secured loan, long-term debts we don't have. So simply capital employed, we are having share capital and reserves and surplus. Only two items are there in this problem. Capital employed. Otherwise, the full meaning of capital employed is equity share capital plus preference share capital plus reserves and surplus plus long-term debts minus fictitious asset. This is the complete items that will come under capital employed. But in our present problem, share capital plus reserves and surplus. 50 plus 51, 1,05,000 is the capital employed. So PBIT is 37,000. Profit before interest and tax 37,000. And capital employed is 1,05,000. So 37,000 by 1,05,000 into 100, that comes to 35.24%. Here I have to multiply into 100. Is equal to 37.54. Why into 100? Because it's a profitability ratio. This return on investment is a profitability ratio. So calculate in percentage. That's all. So this is the end of problem number 6. Now I am reading out problem number 7. See carefully, 7th problem. Calculate the following ratios from the following balance sheet of Mannan Limited given below. So here 1, 2, 3, 4, 5 ratios it is asking you. Debt equity ratio, liquidity ratio, fixed assets to current assets ratio. Actually debt equity ratio and liquidity ratio are old ratios. Normal ratios already I have given the list. In the first 2 videos I have explained you different ratios. In those ratios it is there, debt equity ratio and liquidity. But fixed assets to current assets ratio, it's a peculiar ratio. I told you in the beginning, one of the limitation of ratio analysis is there is no limit on ratios. Unlimited ratios. There is no fixed number of ratios. Unlimited, any number of ratios we can calculate. That is a limitation. There is no finite, there is infinite number of ratios. So this fixed assets to current assets ratio is a peculiar ratio. It is not there in the list. Now we have to derive our own formula. Fixed assets to current assets. Fixed assets to current assets. The formula will be fixed assets by current assets. fixed assets divided by current assets. Next, fixed assets turnover ratio. This formula is already there. It's an old formula. Fixed assets turnover ratio. Revenue from operation divided by fixed assets. And fixed assets to net worth. Again, it's a peculiar ratio. New ratio, we have to derive the formula. When it is given fixed assets to net worth, so take fixed assets divided by net worth. That's all. These 5 ratios we have to calculate. We are given the balance sheet. We are not given any profit and loss statement. We are given only balance sheet. So equity shareholders share capital 1 lakh, reserves and surplus 50,000. Non-current liability, this long-term debt, secured loan 80,000. Previous problem, long-term debt was not there. Here long-term debt is there. Secured loan 80,000. Current liability we have 2. Trade payables and provision for taxation. So 2 current liabilities. Non-current assets, fixed assets, tangible assets 1,40,000, intangible assets 60,000. Current assets, inventory and cash equivalent. We don't have receivables. No receivables, only inventory and cash equivalent. 3 lakh rupees balance sheet tallied. Below that, total sales for the year 5,60,000. Total sales are given 5,60,000. From this information, you have to find out 5 ratios. Now I'll start. First ratio, debt equity ratio. It's a leverage ratio, capital structure ratio. First capital structure ratio. Debt equity ratio is equal to long-term debt divided by shareholders fund. Long-term debt divided by shareholders fund. And long-term debt consists of secured loan in our problem. In the present problem, it is given non-current liabilities. That non-current liability is long-term debt, secured loan. So here long-term debt, secured loan 80,000. Now shareholders fund. Shareholders fund consists of equity share capital plus preference share capital plus reserves and surplus minus fictitious assets. We don't have any fictitious assets. So equity share capital plus preference share capital plus reserves and surplus. But in our problem, we don't have any preference share capital. We are given only share capital. So we'll take share capital plus reserves and surplus. That is shareholders fund. So share capital plus reserves and surplus. 1 lakh plus 50,000. 1,50,000. Over. We got long-term debt. We got shareholders fund. So debt equity ratio, long-term debt divided by shareholders fund. So 80,000 divided by 1,50,000, it comes to 0.53. That means the debt, the long-term debt is 53% of shareholders fund. 53% of shareholders fund. That is the meaning. Next one, liquidity ratio. It is asking you to calculate second ratio, liquidity ratio. Means quick ratio. Liquidity ratio means quick ratio. So quick assets by current liabilities. Quick asset by current liability. Now quick asset. If you see the current assets, only 2 current assets are given, inventories and cash equivalent. So inventory should not be considered. It's a current asset, but it is not a quick asset. So quick asset, only 1 asset, that is cash equivalent in our current problem. If receivables were there, we would have included receivables also, but receivables are not there. So we take quick asset is equal to cash equivalent, 60,000. Current liability directly given in the problem, 2 items are there. Trade payables and provision for taxation. So current liability, trade payable plus provision for taxation, 70,000. So we have quick assets, we have current liability. So quick assets 60,000, current liability 70,000, 0.86:1. This is the liquid ratio, quick ratio. Next ratio, it is asking you fixed assets to current assets. It's a peculiar ratio, it is not there. First time we are coming across. So how to make the formula for this fixed assets to current assets? If it is given 2, that means first word will be numerator, second word will be denominator. If 2 is there, then fixed assets divided by current assets. This is the formula for fixed assets to current assets. So fixed assets, tangible fixed asset plus intangible. Both are fixed assets only. Tangible as well as intangible. So 140 plus 60, 2 lakh rupees fixed assets. Now current assets consist of inventories and cash equivalent, add up 90,000. Over. We got the fixed assets, we got the current assets. So fixed assets 2 lakh, current assets 90,000. 2.22 is the ratio. fixed assets to current assets. Next ratio, fixed assets turnover ratio. It's an old ratio. Already in the previous problems also we have done. Fixed assets turnover ratio. Turnover means sales. Sales means revenue from operations. Sales means revenue from operations. The fixed assets turnover ratio is equal to revenue from operation divided by fixed asset. Revenue from operation divided by fixed asset. The revenue from operation is given 5,60,000 sales, last item. In the problem, last line it is given the sales are 5,60,000. So 5,60,000 divided by 2 lakh, 2.8 times. 2.8 times is the fixed assets turnover ratio. Last ratio is fixed assets to net worth. Again, it's a peculiar ratio. It is not there in the list. It is not has appeared in the previous problem also. So what is that? Fixed assets to net worth. When it is given to net worth, the first word should be numerator, second word should be denominator. So fixed assets by net worth. Fixed assets, already we have calculated 2 lakh rupees. Somewhere we have calculated, yes, fixed assets 2 lakh. Net worth. Net worth means shareholders fund. The meaning of net worth means shareholders fund. And shareholders fund already we have calculated here. Shareholders fund is equal to 1,50,000. No need to again calculate, already we have. 1,50,000 is the shareholders fund and that is net worth. Net worth is equal to shareholders fund 1,50,000. Now fixed assets to net worth is equal to 2 lakh divided by 1,50,000, 1.33. That's it. So we have completed 7th problem. Totally 7 long problems I have explained. So initially 16 short problems and 7 long problems. So if you are genuinely interested in learning, if you have watched this video with full concentration, you will get a lot of confidence on this subject. The only thing, you must have the interest, you must have an urge to learn this topic, because this is very, very important. I have explained each and every point in detail. Hope you are satisfied with my lecture. If you are satisfied, give a like to the video. Share my channel in your group, in your friend circle, so that more students can get benefit from this channel. Give your comments on these videos. And lastly, don't forget to subscribe my channel if you have not yet subscribed. We'll continue the next problem in the next video.